Good morning, my name is Przemysław Kwiecień. You're watching XTB weekly trading webinar. So today we are going to discuss the FOMC decision because it had a significant market impact. The dollar strengthened, gold prices tanked, indices are not doing so great, albeit not all of them. So we'll discuss what actually the Fed did and how this impacted markets. So let's start with traditionally with a quick look on what happened and what are the key market things Monday morning. So obviously these Fed meetings will have ramifications for many days to come. Fed turned slightly more hawkish. We'll explain what it means in a few minutes. But Friday was very interesting because James Bullard, one of the FOMC members, actually added much more fuel to what they did. So the initial turn that the Fed made on Wednesday was very, very, very tiny, and there were opinions that, well, maybe that's not such a big deal. But Bullard's remarks on Friday were much more significant, which is the reason why there will be so much focus on, as you can see, a long, very long list of Fed speeches this week. The market will want to know what actually is thinking among the FOMC. Are they really worried about the inflation? Because the Powell officially was not, but maybe he wasn't 100% honest with market participants. And are there more concerned members like Bullard? This will be interesting this week. So this list, as you can see, every day there is some kind of speech. So certainly this is something that needs to be watched. So far, this beginning of the Monday trading is a bit nervous, especially in Japan, where the Japanese Nikkei 225 declined. At some point, the decline was close to 4%. So really, markets is in some corners is starting to take this seriously. US dollar makes really consistent and large gains and hits precious metals and other commodities, with gold at the key 1765 support and a possibility of a retest of even bigger support, $85 lower. So we'll discuss all this chart in a minute, but let's start from the previous week, where it was dominated by the Fed, but I will also mention China because it is a bit off the radar and it might also be important going forward. So first of all, if you look at indices starting from the beginning of last year, you might see that for the major indices we are still so much higher and there is no real impact, especially the Nasdaq, the index that had the slightest drawdown during the pandemic crisis. It's still at the top. So the index that technically should be the most sensitive to interest rates is doing great. So not such a big change here. And like I said, all the focus is on the Fed, and maybe for the right reasons, but China is off the radar, and what they actually do, they do a lot of tightening at home. The question is, why would they do that? Well, I think they are doing this because they can do. They have a long time horizon. What they worry about is not a nominal growth this year like the US, but a longer term relationship between their growth and the US growth. And they understand that in order to beat the US, to become the number one globally, they need consistent growth. They cannot overheat the economy like the Fed does with the Biden administration, but they need to do it step by step. And the pandemic, I think, was just a great example, which might be unfortunate for us, but despite the early setbacks that they had during the pandemic, they actually won. If you look at their share in global trade, it increased dramatically. If you look at their GDP versus the US GDP, they again took a big step forward. So this approach, where the policy is much is more moderate is actually working for them. And I think they see what's happening with these crazy flows in investment, and they are putting the brakes. And if you look at this greenish line here, this is Chinese credit impulse, and as you can see, it's already turning sharply down. On this index, on this chart, it's moved 12 months forward, so this technically should herald a slowdown next year. This would be quite important for the market, because obviously China is important globally. So in order to cool residential sector, to cool overinvestment, what they're doing, they're already putting the brakes. So obviously this will be important for the market, because even if we look at the last week, we can see obviously US dollar doing great due to the Fed, but commodities not doing so good anymore. And obviously the Fed is one reason, but what happens in China is the second reason. And it also means that the PMI indices that we'll have in calendar this week are important to watch, because they should in a few months start showing us if the peak scenario is actually the one that will take place. But let's start with the FOMC decision, and let's explain how to read it and why the market reacted in the way they did and what can lie forward. So first of all, the impact was from that chart, and the focus was on this chart, which basically shows that there are more FOMC members who see interest rate hikes, and actually more than one in 2023. This wasn't the case in March. There were only a few members that saw the probability of the hike, whereas here obviously there is a majority that at least sees at least one hike in 2023. Obviously this is still very distant. We are in 2021, so this is 2 years time, but with the market so sensitive to the FOMC policy, this is already a change. And you can see it in this table. The median went up from 0.1 to 0.6. Otherwise, there weren't many changes here. To be frank, the main policy parameters remain unchanged. The quantitative easing remains unchanged at 120 billion per of printing per month, and the policy rate remains in the 0 to 0.25% corridor, which is historically lowest point. So obviously this policy remains very, very accommodative. What they did, they increased technical rates, which is IOR, and this is the rate of on excess reserves, and reverse repo rate by 5 basis points. This is obviously not a big step. This is the smallest possible step. 5 basis points is just 1% of today's annual inflation in the US, but that's already something. In the environment when you have negative rates in euro, when you have negative rates in the Japanese yen, then positive 5 basis points that the Fed pays on reverse repo, it's already something. And you can see the impact on the FX market with the US dollar gaining so much, which I will show in a minute. The other change that the Fed did was actually saying that they will pay attention to the data. If you saw the reaction to the two previous CPI prints in the US, the Fed pretty much ignored it. They said inflation transitory, we don't need to worry about it. But now Powell is saying, look, we will pay attention to the data, and if the data continues to run strong, with employment growing, with inflation remaining high, we will taper, we will reduce quantitative easing regardless of market ramifications. So from now on, we'll certainly pay a lot of attention to the data that I showed over here. And as you can see, historically, 2018 was a year where markets really struggled, and that was the only really negative year for indices in the last decade, and the Fed was the prime reason why it was the case. However, as you can see here, we are very far from it. We are very far from it. That was the year where the Fed actually decreased their balance sheet. So as you can see, even in combination with ECB and Bank of Japan, on a net basis, we had money withdrawal from the market. We are very, very, very far from this point right now. We are still at the peak of printing, other than the short period of the pandemic crisis last year, but we are still way higher than at any point during the previous QE experiments during the past decade. So to sum up with the Fed, the markets are fully reliant on accommodative policy, and this is a big risk, because as you can see in this table, it's maybe not very obvious with so many numbers here, but I made the dots for you on which measures the S&P 500 is either the most expensive in history comparing to previous cycle highs, or close to it. And as you can see, this is vast majority. So the market is very, very expensive. It is very stretched. Then again, the Fed, despite the turn, they still will conduct very accommodative policy. But with the market so reliant on the Fed, any bigger change in their policy may translate into big market, obviously negative, big market reaction. We are not there yet. They haven't made this turn. They made only very slight tilt. But if the next month showed that inflation does not return to 2.5%, but remains on elevated levels, this will be the moment when the markets may start panic. So far, if you can see, the reaction was limited on indices. Here you see DAX, where we had big pull down on this bullard comments on Friday, but already today, as you can see, the most of the declines from the Asian session have so far been erased. Also, S&P 500 is already on the green today, and as you can see, we are not even that has not yet been even a profit taking. We did not have a proper correction for many months, and the last one was last year, and we only had small profit taking, around 4-5% drawdowns. That was the maximum, and we are not even there yet. So far we are definitely in upwards trend on this very stretched market, but there are not yet decisive signs. Also on Nasdaq, as you can see, what I showed at the beginning, here we are actually higher than we were before the FOMC decision. So this is completely crazy. This only shows that there is so much money on the market, and the investors see what the Fed is doing, but they still don't know what to do with their funds. And until this changes, it might, the small tilt that the Fed did, it's not enough. They need to do much more. They need to be forced by high inflation to do much more in order to spook markets seriously. The reaction was much more severe on the dollar, and here the deal is greater, because like I said, even small positive rates offered by the Fed, that's more than you have in euro or in Japanese yen. So here I would say the deal is real, and I'm not surprised by this move. We actually had a meeting, I think 3 weeks ago, when we discussed US dollar, and I was saying by then that US dollar was very oversold, and the conditions were not bad to bet on the reversal of fortunes for the US dollar, and here we are. So I'm not surprised here. I'm thinking the changes done by the Fed are more relevant for US dollar than for equities. And because US dollar is doing well, and you can spot even some kind of head and shoulders here, we had also strong impact on precious metal prices, with gold revisiting very important support of 1765, a support that already helped gold defend from steeper declines in November of last year, and now we are trying a similar move here. So I would say, from a speculative perspective, this is not a bad level to consider. If it doesn't hold because of strong dollar and we move lower, then 1680 will be another one to watch. So this is gold also is a very interesting market to watch right now. All right, let's take a look at what is awaiting us this week. Obviously, this will be this long symphony of Fed speeches. what I think is that majority of them, they will try to tone down what Bullard said on Friday. They will try to calm markets down. So expect maybe slight watering down of the strong reactions that we had on Friday. Other than this, we have data of PCE inflation in the US. PCE is the measure that the Fed watches the most. However, it is released with a 2 or 3 weeks delay to the CPI, so markets already know what to expect. But you know, with the Fed so much reliant on inflation right now, it is still worth watching. Also, PMI indices will be important because we had very strong rebound from the pandemic, but already last month we had some problems in the US. And what I showed you with this Chinese credit impulse, if the economy is already peaking, we could be in trouble here because we have inflationary pressures, and at the same time, if the global economy was already at the peak, this is certainly not something that markets would like to watch. So these indices are definitely worth watching. Even if there will not be a great deal of reaction this week, this probably will carry some more long-term information for us investors. All of this you can watch in the news section of XTB trading platform and XTB mobile trading platform. So I encourage you to stay on top of the market by watching the coverage that we prepare for you. And I will see you next Monday, 7:30. Have a great week.